Right now, in March 2026, we are watching a massive geopolitical war and an energy crisis rip through the global markets, and yet the US dollar and gold are both skyrocketing simultaneously.
Which mathematically should not happen.
Right. Those two assets are mathematically programmed by decades of financial history to move in exact opposite directions. But that physical law of finance is just completely breaking down in real time.
Yeah, the models are failing. And we are looking at the hidden fractures of a system in severe distress.
It's wild.
The apparent invincibility of the US dollar today isn't a sign of enduring strength. It's actually a symptom of a violent structural shift. We're going to show you why the entire architecture of global trade is reconfiguring right beneath the surface. And the scary part is, most market participants won't recognize that the old system has stopped working until they are just entirely locked out of the new one.
Exactly. So welcome to this deep dive. We have a highly classified, comprehensive macroeconomic and geopolitical intelligence report right here in front of us. And our mission today is to unpack the absolute fallout of this March 2026 Middle East conflict, what the military is calling Operation Epic Fury, and track its really profound existential impact on the US dollar.
It's a massive web to untangle.
It really is. Now, I do need to make a very clear note to you, the listener, before we tear into this data. This material covers highly sensitive, ongoing political and military events involving the U.S., Israel, and Iran.
Right, very charged stuff.
Very. We are not taking sides here.
Yeah.
We're not endorsing any political figures, and we're absolutely not validating any military actions or doctrines. Our sole objective for this deep dive is to impartially strip down the facts, the market data, and the economic projections exactly as they are laid out in these sources.
Because treating this intelligence as a raw mirror of the global markets is really the only way to read it accurately. We're here to read the reflection, not judge the mirror itself.
I love that framing.
And that reflection shows an economy experiencing a sudden and irreversible paradigm shift.
Okay, let's unpack this. We have to start at ground zero of this data set. The catalyst tearing the markets apart right now is the sheer unprecedented scale of this late February U.S.-Israel joint military campaign against Iran.
Yeah, Operation Epic Fury.
Right. And the sources are incredibly clear that this wasn't, a localized skirmish. This wasn't a proportional response like that 12-day war we saw back in 2025.
No, not at all.
We are looking at a massive, immediate shift from back-channel diplomatic negotiations in Geneva directly into what military strategists categorize as decapitation strikes.
Which is a terrifying escalation.
The stated operational goal shifted entirely to regime change. The coalition targeted government ministries, underground command posts, heavy military installations across, get this, at least 9 major Iranian cities.
9 cities simultaneously.
Yeah. And the intelligence confirms the reported deaths of Supreme Leader Ali Khamenei and top military officials. We're talking the absolute upper echelon of the Islamic Revolutionary Guard Corps.
And a physical action of that magnitude, it instantly destroys the geopolitical equilibrium of the entire region.
You can't just contain that.
Exactly.
Yeah.
You don't execute a decapitation strike without triggering an automatic, decentralized, and highly asymmetric response. The whole system over there is designed to react even if the head is cut off.
A dead man's switch, basically.
Essentially, yeah. And the report details exactly how that played out. The so-called axis of resistance launched a massive, coordinated regional retaliation. The data here tracks drone swarms and ballistic missile strikes hitting across Israel, Jordan, Saudi Arabia, Qatar, Kuwait, the UAE, and Bahrain.
The entire Arabian Peninsula.
The entire peninsula. This morphed instantly from a targeted bilateral campaign into a full-blown regional war.
In the investment banks cited in the report, they're modeling an active, high-intensity phase lasting anywhere from 3 weeks to 2 months.
Which is a lifetime in market terms. But while the physical strikes on land are devastating, the report highlights that the most immediate critical casualty for the global economy is actually geographical.
It's in the water.
It's in the water.
Strait of Hormuz.
If we want to map out why the global financial system is essentially having a heart attack right now, the lens has to focus entirely on that specific choke point. It is the literal jugular vein of the global energy market.
And the geography of it is what makes it so incredibly fragile. To visualize this based on the maritime data, the strait is roughly 33 kilometers wide at its narrowest point.
Right, which sounds like plenty of room.
It sounds huge, but that number is a complete deception. The actual safe navigation channels, the deep water trenches that are required for a very large crude carrier, a massive supertanker, to pass through without running aground, Those channels are merely 3 kilometers wide in each direction.
A 3-kilometer lane for vessels that literally take miles of open water just to hit the brakes and stop.
You could practically swim across a navigable channel. It's nothing.
And according to the live maritime tracking data, we are currently looking at a de facto blockade of that tiny channel.
It's a complete standstill.
Yeah. Now, the report notes a crucial detail. Iran hasn't formally declared the Strait closed under international maritime law.
Because that would be a massive escalation on paper.
Exactly, a formal act of war against global shipping. But practically speaking, the legal status doesn't matter one bit.
Right.
IRGC fast attack patrol boats are out in the water right now, and they are issuing direct VHF radio warnings to commercial ships, instructing them to turn around immediately.
Just getting on the radio and saying, do not enter.
Yeah. And you combine those active radio warnings with the looming threat of anti-ship ballistic missiles on the coast, untethered sea mines floating in the channel, and kamikaze drone swarms, and the entire logistical transit system just freezes in place.
It just stops.
Yeah.
And the mechanism of that freeze is what I think the market fundamentally misunderstands. People think it's about the captains.
Right, like the captains are just too scared to sail.
Exactly.
Yeah.
But the halt isn't driven by captains feeling fearful. It is driven by hard, cold financial mathematics. The global maritime insurance market reacted to those VHF warnings in a matter of hours.
Hours. The syndicates at Lloyd's of London, the primary providers of global marine risk insurance, they look at a 3-kilometer channel surrounded by anti-ship missiles, and they adjust their actuarial tables instantly.
Yeah, don't mess around.
They absolutely do not. They either completely suspended their policies for any vessel entering the Persian Gulf, or they hiked their war risk premiums to levels that are just economically absurd.
Unpayable.
Yeah, because if a shipping company cannot secure insurance for a $150 million vessel carrying $100 million worth of crude oil, they cannot legally or financially sail.
It's a hard structural stop.
A complete wall.
And we are seeing the physical manifestation of that hard stop right now. The routing data in the source document shows giants of global shipping Maersk, Hapag-Lloyd. They've entirely halted transit.
Shipping anchors.
Yeah, they're ordering their fleets to drop anchor in the Arabian Sea, just sitting out there entirely outside the danger zone, waiting.
Which is wild to visualize, just a parking lot of supertankers in the ocean.
Taking a step back, taking 20% of the world's seaborne crude oil offline in an afternoon is staggering. That's 1 in 5 barrels.
And it's not just crude. A massive percentage of the world's liquefied natural gas, LNG, flows through that exact same 33-kilometer gap.
And there's a secondary data point here that is deeply, deeply concerning.
Yeah.
33% of global urea flows through that strait.
A fertilizer.
Right. Taking a third of the world's vital nitrogen fertilizer offline isn't just a shipping delay problem. That is a direct hit to global crop yields and food security for the next 2 planting seasons.
And people might ask, well, what about pipelines? Can't they just bypass the water?
The infrastructure data confirms there are 0 adequate pipeline alternatives to bypass this. The Saudi East-West pipeline can handle maybe a tiny fraction of this volume, but nowhere near enough to replace the Strait.
We are witnessing a textbook supply shock, executed with just brutal geographical efficiency. When you pinch off a fifth of the world's oil, a massive chunk of its LNG, and a third of its fertilizer, the math of the global economy is forced to violently recalculate.
The market just loses its ability to price risk smoothly.
Probably it loses it.
And the market freakout, detailed in the pricing data here, is wild. When the commodity markets opened after that initial weekend of strikes in late February, the benchmark numbers broke trend entirely.
Oh, they shattered.
Brent crude spiked 8.5% almost instantly, hitting $81.57 barrel. And the intraday trading logs show it actually touched 13% up at its peak. The U.S. benchmark, WTI, jumped over 6%.
But the really terrifying chart in this whole report is the European natural gas market, the TTF futures.
Oh man, the TTF.
They gapped up anywhere from 25 to 38% right at the open.
And we should explain that that concept of a gap up is a really vital signal to read.
Yeah, it means the price didn't gradually climb to that level through normal, steady buying and selling. It literally opened the next trading day 38% higher than where it closed on Friday.
There was no price discovery, just pure blind panic repricing.
Right. And the source document highlights a specific macroeconomic model from Goldman Sachs to explain the oil side of this. Their quant suggests that an $18 risk premium per barrel is currently baked into the spot price.
$18 just in fear.
Exactly. That $18 isn't based on oil that has actually been destroyed in a refinery fire. It is the market mathematically pricing in the expectation of losing 2.3 million barrels a day of supply, assuming a baseline 6-week blockade scenario.
Assuming 6 weeks, I look at that $18 premium and I have to ask,
Yeah.
what happens to that model if the conflict drags on longer than 6 weeks? What if those IRGC patrol boats don't leave the channel?
That's the nightmare scenario. The projections from S&P Global and UBS take us into a phase they define as scarce supply rationing.
Scarce supply rationing.
Yeah, if the choke point remains closed and global inventories start to physically drain out, the market stops functioning on normal marginal cost curves. It moves into absolute survival mode. We are talking about models rocketing past $120 a barrel. It becomes a structural shift into consistent, 3-digit oil prices that would dwarf the inflationary shock we saw back in 2022.
Because in 2022, the oil was still flowing, it was just being rerouted or sanctioned.
Exactly. This time, the physical infrastructure is actually paralyzed.
And the transmission of this shock into the real economy, that's the part of the report that feels the most immediate to you and me. How does a blockade thousands of miles away hit a local business or a consumer buying groceries?
It's all connected through the base layer of manufacturing.
Chemicals. Crude oil isn't just fuel that goes into a gas tank. It's a basic physical feedstock for plastics, resins, industrial chemicals.
The building blocks of everything.
Exactly. And the financial models showed that between 15 and 20% of the operational costs for major chemical plants are tied directly to energy and feedstock. So their profit margins are just being eviscerated overnight.
And then look at the cascading effect through the logistics chain. It's even more severe. Look at the breakdown of aviation and trucking overhead in the data. Jet fuel traditionally makes up 20 to 30% of an airline's total operating costs.
That's massive.
And diesel can account for up to 25% of the cost for ground logistics and long-haul trucking.
So if 18% of the world's jet fuel and 9% of its diesel is suddenly trapped behind an invisible insurance wall in the Persian Gulf,
global freight rates explode, airline ticket prices explode.
And because literally every physical good on a store shelf is transported on a truck or a cargo plane, this logistics crunch creates a massive wave of secondary inflation. It just washes over every consumer market on the planet.
But, and this is a huge but, the report highlights a massive asymmetry in how this wave is hitting different countries. This isn't a uniform global crisis where everyone suffers equally.
Right. There are very clear devastated losers.
Yeah.
And there was one relative winner sitting on the other side of the ledger.
The industrialized nations in Europe and Asia, so Germany, Japan, South Korea, Taiwan, they are structurally dependent on foreign energy. The data shows they import over 80% of their hydrocarbons.
80%.
In macroeconomic terms, those nations are suffering a catastrophic disruption of their terms of trade.
Right. Let's break that down for the listener.
When the price of the energy you absolutely must import just to keep your power grid alive skyrockets, you are forced to hemorrhage your foreign currency reserves just to buy the exact same amount of power you bought last week.
You're running twice as fast just to stay in place.
Exactly. And that dynamic is why we are seeing the euro and the Japanese yen taking absolute beatings in the forex markets right now. Institutional investors are looking at the European industrial heartland places heavily reliant on that TTF natural gas, and they're realizing that any hope for a European industrial renaissance is dead on arrival.
You can't run a heavy manufacturing base in a world of structurally expensive, highly volatile energy.
You just can't compete.
And the emerging markets are bleeding out even faster. The data on Turkey in this section stopped me in my tracks.
Oh, the reserve burn is crazy.
Turkey is so incredibly vulnerable to this imported inflation that their central bank is burning through their massive $206 billion foreign exchange reserves just to intervene in the currency markets.
They're just throwing cash into a furnace.
Literally, just to prevent the lira from entering a death spiral. That is a staggering amount of national wealth vaporizing just to defend a currency peg.
And we also see Romania and Hungary in the report. These are nations that desperately needed to cut interest rates to stimulate their domestic economies.
But they're being forced to abandon those plans entirely. The models show that every 10% increase in global oil prices adds half a percentage point to Romania's inflation rate almost instantly.
They're completely trapped.
So that's the loser column. But we have to pivot to the other side of the ledger to understand the current strength of the dollar. The United States is experiencing this crisis through a completely different historical lens.
Yeah, we are looking at a dynamic that is entirely unique to this specific era. They call it the U.S. Shale Shield.
The Shale Shield.
If a decapitation strike and a Strait of Hormuz blockade had happened during the 1970s oil embargoes, or even during the early 2000s, the U.S. economy would be in a synchronized death spiral right alongside Europe.
Gas lines around the block.
Exactly. But the current production data changes everything. The U.S. is pumping out a record 13 million barrels a day, heavily driven by the Permian Basin and other shale plays. That sheer volume of domestic production covers roughly 65% of total U.S. consumption.
So from a purely physical standpoint, the U.S. is largely isolated from the actual deficit of oil. They aren't facing the prospect of the lights turning off or the gas stations running completely dry.
Right, the physical supply is secure. But does the average U.S. consumer still pay significantly more at the pump?
Oh, absolutely.
Yes, because crude oil is a globally traded, fungible commodity. A price spike in Brent crude over in Europe drags up WTI in Texas. It acts like a highly regressive tax on the American driver.
You're still paying $5-6 a gallon.
Right, but we have to look at where those extra dollars are going. This is the key. The money leaving the consumer's wallet at the gas station isn't leaving the borders of the United States to pay a foreign producer.
It's staying in the house.
Exactly. It's flowing directly into the balance sheets of domestic oil and gas giants, pipeline operators, and geological service companies based in Texas and Oklahoma. The capital is simply moving from one side of the U.S. domestic economy to the other.
While Europe bleeds its sovereign wealth outward to the Middle East and Norway, the U.S. retains its wealth internally.
And global capital allocators see this stark contrast. They view the U.S. as an insulated energy fortress. So what do? Capital floods out of those vulnerable European and Asian markets and pours directly into U.S. dollar-denominated assets.
Here's where it gets really interesting, though, because that winner status for the U.S. feels like a complete mirage when you actually look at the internal domestic data in this report.
Yeah, the macro view hides the micro pain.
The Shale Shield is masking a deeply fragile consumer base. Before this war kicked off, the prevailing narrative was that the U.S. Federal Reserve had engineered this perfect soft landing.
Everyone was cheering for it.
Right. The headline GDP was growing at a very healthy 2.2% to 2.7%. But when you dig into the sources, that growth was wildly top-heavy.
Yeah.
It was largely driven by a massive corporate capital expenditure boom in artificial intelligence.
The Magnificent Seven tech stocks were essentially pulling the entire statistical average up by themselves.
Exactly. The headline GDP was a beautiful facade covering a K-shaped economic reality.
And we should explain that K-shape. The top leg of the K is pointing sharply upward. Asset owners, corporations investing in AI efficiency, people heavily invested in real estate or equities, they are seeing their net worth expand rapidly.
But the bottom leg of the K is pointing aggressively downward. The average wage-earning consumer is being squeezed by a frozen, completely unaffordable real estate market, maxed out credit card utilization, and a labor market that is showing deep, hidden fractures beneath that headline unemployment rate.
So you take that heavily leveraged, deeply fragile consumer base, and you drop an inflationary perfect storm directly on their heads.
A perfect storm.
Mm-hmm.
Because even before the first missile was fired in Operation Epic Fury, inflation was proving incredibly stubborn.
It was sticky.
Very sticky. The core personal consumption expenditures index core PCE, which strips out volatile food and energy, and is the specific metric the Federal Reserve targets, was sitting at 4.3%.
Which is more than double the Fed's mandated 2% target.
Double. And then you layer in the aggressive import tariffs introduced by the Trump administration, which the data shows were already driving up wholesale supply chain costs before February.
And then the storm makes landfall.
Right.
You drop an isolated 10% spike in gasoline prices from the Middle East conflict on top of the tariffs and on top of the sticky baseline inflation. The macroeconomic models in the report indicate that a 10% gas spike alone adds 0.2 to 0.4 percentage points to headline inflation.
Just boom, right to the top line.
Yeah. So when you stack the geopolitical energy shock on top of the structural tariff shock, the Federal Reserve's tolerance for elevated inflation is officially broken. Their policy models are completely boxed in.
The bond market reaction to this is violent. The Fed is caught in a massive trap.
Look at the yield curve mechanics to really understand the severity of this trap. Prior to the February escalation, bond traders were heavily pricing in the expectation that the Fed would lower interest rates at least twice in 2026.
Right. Everyone wanted those rate cuts.
Because the logic was that a rate cut would relieve pressure on that struggling lower leg of the K-shaped economy. make mortgages cheaper, make credit card debt less crushing.
But the moment the Strait of Hormuz effectively closed, the bond market violently repriced.
Traders realize the Fed absolutely cannot cut rates now. If the central bank cuts rates while supply-side inflation is surging from a localized oil shock and new tariffs, they risk igniting a 1970s-style stagflation spiral.
The Fed is trapped.
They are mathematically forced to keep their benchmark interest rate elevated at 3.50% to 3.75% for an extended, indefinite period.
So higher for longer isn't just a talking point from Powell anymore. It's the defining reality of the debt markets.
It creates a phenomenon bond traders call a bearish flattening of the yield curve.
Let's break that down.
Okay, so short-term interest rates spike aggressively because the market knows the Fed isn't offering any immediate relief. But long-term rates, like the 10-year Treasury, they rise much more slowly, or they even drop.
Why? Why would the 10-year drop if inflation is up?
Because the market also knows that keeping short-term rates this high while the consumer is choking on $5 gas and high credit card APRs, that will eventually break the economy. It will cause a severe recession down the road. The bond market is basically screaming that the immediate future is tighter and the distant future is a contraction.
And if we connect this to the bigger picture, this specific yield curve dynamic ties perfectly back to why the US dollar is surging. The Fed is trapped into maintaining super high interest rates, while central banks in Europe and Japan are managing stagnant economies that desperately need lower rates.
Which creates a massive policy divergence.
A massive yield advantage for the United States. I mean, put yourself in the shoes of a global sovereign wealth fund manager right now.
Right.
Why would you park billions of dollars in Europe, where the yields are low and the entire industrial base is starved for imported natural gas, when you can park it in U.S. Treasuries? You sit safely behind the American shale shield, and you earn a massive, risk-free interest rate.
It's a no-brainer. That undeniable gravitational pull is exactly what is driving the US dollar index, the DXY, to look utterly invincible against its fiat peers right now.
It is a brilliant tactical triumph for the dollar in the short term. But, and this is the crux of the episode, as we peel back the next layer of this intelligence report, we uncover a profound historical anomaly.
The tactical strength of the dollar is actually masking a breakdown in the very physics of the global financial system.
The great anomaly. This is the section of the data that just completely defies traditional market logic.
It's fascinating.
We have an incredibly strong surging US dollar. We have high sustained interest rates. Now, if you read any financial textbook, the traditional laws of financial physics state that when the dollar is strong and government bonds are paying high risk-free yields, gold is supposed to get absolutely crushed.
Because gold is a non-yielding asset.
Exactly. It's a shiny yellow metal that sits in a vault in the dark. It doesn't pay you a quarterly dividend, and it doesn't pay a coupon yield. The rational move is to sell the rock and buy the high-yielding U.S. Treasury bond.
But that's not what's happening.
Not at all. Right now, in the aftermath of Epic Fury, gold didn't crash. It shattered resistance levels and hit an all-time absolute record high of $5,417 an ounce.
Unbelievable.
And silver jumped a mind-bending 184% over 10 months to $97 an ounce. The US dollar and precious metals are skyrocketing at the exact same time.
The traditional correlation models are broken. And when gold and the dollar rise together like this, it raises critical systemic red flags about the true underlying health of the financial architecture.
Something is fundamentally wrong beneath the hood.
Exactly. The sources identify 3 distinct structural drivers forcing this broken correlation, and they point to a system preparing for a massive fracture. The first driver is the most immediate, the ultimate risk-off scenario.
So geopolitical panic overriding yield mechanics.
Exactly that. The sudden, visceral threat of a widening regional war, active regime changes in heavily armed nations, and the literal paralysis of global energy logistics, it has triggered a primal fear in capital markets.
Survival mode.
At $5,417 an ounce, gold is no longer being evaluated against the opportunity cost of a dollar's yield. It is acting as the ultimate zero counterparty risk doomsday hedge.
Right. When sovereign entities and massive institutions fear that the geopolitical order itself is unraveling, they don't care about earning 4% on a U.S. bond.
They just want to hold a hard, physical asset that cannot be destroyed by a state-sponsored cyber attack, frozen by a sanctions package, or defaulted on by a collapsing government.
The second driver is even more foundational, I think, because it involves the largest financial players on the board. Central bank accumulation.
Huh?
We aren't talking about retail investors buying coins on TV.
No, this is state-level hoarding.
The institutional foundation under the gold price has fundamentally changed. Developing nations, particularly those operating within the expanded BRICS bloc, are aggressively and relentlessly buying physical gold on the open market.
And the crucial detail here is that they are price agnostic.
They don't care what it costs.
They are buying by the ton regardless of whether the dollar is at 95 or 105. This massive, coordinated central bank demand is actively creating an artificial, permanent floor under the price of gold.
The price cannot discover a natural bottom.
Right, because the moment it dips even a fraction, a sovereign nation's central bank steps in to absorb the liquidity and pull tons of physical metal into their domestic vaults.
But why are they hoarding so aggressively right now? That leads directly to the third driver in the report, fiscal dominance. This is the global market waking up to the mathematical reality of the U.S. government's balance sheet.
Institutional investors and foreign governments are looking at the trajectory of U.S. debt, and they are terrified.
The numbers are staggering. The International Monetary Fund data projects the U.S. national debt to hit 130% of its gross domestic product within a 5-year window.
130%. The math is becoming inescapable. The market is looking at that compounding debt load combined with the higher for longer interest rates we just discussed and realizing that the U.S. government will eventually be forced to monetize that debt.
Explain monetization for the listener.
It means they will have to print an enormous inflationary volume of dollars just to pay the interest obligations on the existing bonds. Massive institutions increasingly view fiat currency, any paper money, as fundamentally doomed to long-term devaluation to pay for these sovereign debts.
So gold is being accumulated at record highs because it is perceived as the only independent, unprintable monetary anchor left in the system.
The dynamic is fascinating. The dollar looks incredibly strong today because of a localized energy shock and high interest rates. But gold is soaring because the smartest, largest pools of capital in the world know the dollar's underlying structural foundation is rotting.
Which brings us to a massive, silent shift detailed in the final sections of the report, the stealth architecture of de-dollarization.
Here we see the tactical, short-term strength of the dollar actively clashing with its strategic, long-term vulnerability. Over the last decade, the United States has increasingly utilized its financial system and the dollar itself as a direct weapon of foreign policy.
Right, sanctions.
The ability to freeze a sovereign nation's central bank reserves or cut their commercial banks out of the SWIFT messaging system, that is a tremendous unparalleled power.
But when you weaponize the world's reserve currency, you inevitably force every nation that isn't your direct treaty-bound ally to build an escape hatch.
And the data proves the escape is already underway.
The silent exodus.
Yes. Because despite the DXY index testing massive highs right now, the actual underlying market share of the dollar in global trade is bleeding out. The IMF's data on official foreign exchange reserves shows the US dollar share has dropped to 56.92%.
Now, some people will hear that and say, well, 56% is still a tactical majority.
But the context is everything. It was sitting at 71% back in 2001. That is a steady, undeniable, and accelerating exodus away from dollar reliance.
The global south has moved past simply complaining about U.S. financial hegemony. They are actively engineering a parallel financial universe. And the crown jewel of this new sanctions-proof architecture is the BRICS bridge.
I'm glad we're talking about this because we really need to get into the mechanics of the BRICS bridge.
It sounds like a theoretical concept, like a white paper.
But the sources confirm it is entirely real and it is operational. BRICS bridge isn't a new paper currency like the euro. They didn't try to print a single BRICS banknote. It's a native blockchain architecture designed specifically for the 2025-2026 geopolitical reality. Attempting to create a single fiat currency for the BRICS nations was always politically and economically impossible.
Because India absolutely refuses to have its monetary policy dictated by the People's Bank of China.
Exactly. And the economies of Brazil, Russia, and South Africa are far too disparate to share a single interest rate. It would be a disaster. So instead of monetary union, they opted for technological decentralization.
BRICS Bridge is a decentralized payment and clearing system that entirely bypasses the Western-controlled SWIFT network.
Entirely. And the technical specifications in the report are staggering. The system can process 20,000 transactions a second.
20,000. That is Visa-level enterprise scaling.
It is. And the way they achieve that is by utilizing central bank digital currencies, or CBDCs.
To understand the shift, contrast this with the old system. Under SWIFT, if a bank in Brazil wants to pay a manufacturing factory in China, the transaction usually involves correspondent banking in New York.
It takes days to clear.
It requires U.S. dollars, and it is subject to U.S. Treasury oversight and potential sanctions.
But with BRICS Bridge, they use the digital real and the digital yuan to execute an instant, cross-border smart contract settlement directly on the ledger.
No dollars, no New York correspondent bank, zero U.S. visibility.
This raises an important question. The mechanics of that atomic settlement raise the most dangerous question for the future of the American economy. What happens to the U.S. financial system when the rest of the world simply doesn't have to buy U.S. dollars or hold U.S. treasuries just to facilitate their own bilateral trade?
The U.S. loses what economists call the convenience yield.
That convenience yield has been the absolute bedrock of American economic supremacy. For decades, the U.S. has enjoyed a massive, invisible subsidy from the rest of the global economy.
Because every nation needed dollars to buy crude oil or to trade manufactured goods with their neighbors, there was an artificial, insatiable global demand for U.S. Treasury bonds just to hold those dollars in.
And that global demand allowed the U.S. government to borrow trillions of dollars at artificially low interest rates.
But if Russia and China are suddenly trading energy in rubles and yuan,
And Brazil and India are settling agricultural contracts instantly on a blockchain.
that artificial systemic demand for U.S. debt vanishes. The U.S. permanently loses that convenience yield.
The brutal mathematical consequence is that to fund a 130% debt to GDP load without the world blindly buying your bonds, the U.S. government will be forced to offer brutally high interest rates to domestic buyers just to attract capital.
And the interest payments alone will consume the entirety of the federal tax revenue.
The math doesn't lie.
So we've tracked the escalation of the war, the logistics paralysis in the Strait, the oil supply shock, the Fed's inflationary trap, the anomaly of gold breaking the models, and the stealth launch of a blockchain architecture bypassing SWIFT. Let's synthesize all of this data into the 2026-2027 horizon.
The road ahead.
What is the actual paradigm shift we're facing?
The consensus projections from major investment houses, we're looking at JP Morgan and Morgan Stanley here, they paint a picture of a transition separated into two very distinct, highly volatile phases.
Okay, let's start with the short term.
In the immediate short term, mapping out Q1 and Q2 of 2026, we are living in the phase of peak absolute dollar dominance.
The data supports that peak. Because the Middle East is still burning, the energy supply is still trapped behind the insurance freeze, and the Fed is forced to hold rates high to fight the supply shock.
Exactly. The DXY index will likely test 100 points as capital hides in the US.
The euro gets battered down toward the 1.1575 level as their industrial base chokes on structurally expensive natural gas.
The Japanese yen stays incredibly weak, breaking above 150 to the dollar, because the Bank of Japan is completely outgunned by the yield offered by the Fed.
If you're a Forex trader looking at a screen right now, the dollar feels like an unstoppable wrecking ball.
But the long-term macroeconomic projection moving into H2 2026 and throughout 2027 points to a massive structural bearish reversal.
The cycle is ending.
The cycle is reaching its terminal end. The very dynamics keeping the dollar artificially strong right now will be the catalyst for its undoing.
Those higher for longer interest rates from the Fed are a blunt instrument.
They are going to eventually break the back of the U.S. consumer. When the housing market remains frozen and unaffordable, when credit card debt compounding at 24% becomes unmanageable for the middle class, and corporate borrowing costs stifle any new hiring, the U.S. economy will inevitably slide into a severe, undeniable recession.
And the moment that domestic recession hits hard enough, the Fed's priorities have to flip. They can't play tough on inflation anymore if the labor market is actively collapsing.
They will capitulate. To save the U.S. economy from a deflationary depression, the Fed will be forced into a cycle of aggressive, panic-driven rate cuts.
And the moment those interest rates plummet,
The massive yield advantage, that gravitational pull that was hoarding global capital inside the United States, it vanishes instantly. JP Morgan's forward models project the DXY index plunging from that peak of 100 all the way down to the 94-95 range as capital floods back out into a newly structured global market.
we are looking at a fundamental transition. Not an overnight collapse where the dollar goes to zero like some doom-scrolling blogs predict, but a structural transition away from absolute, unipolar, U.S. dollar hegemony.
We are entering a fragmented, deeply multipolar financial system. In this new 2027 reality, the strength of a nation's currency isn't just going to be determined by what their central bank sets the overnight interest rate at.
It's going to be determined by the physical and technological bloc they belong to.
Exactly. Do you have sovereign control over physical energy supplies? Do your commercial banks have direct access to the BRICS blockchain settlement layer? Are your central bank reserves backed by thousands of tons of physical gold or just paper promises from a heavily indebted foreign government?
It is the definitive end of the unipolar financial era we've lived in since Bretton Woods.
The architecture of a post-dollar world isn't a theory debated in academic papers anymore. It is fully built, it is live, and it is processing thousands of transactions a second right now.
So what does this all mean for you? We've seen how an explosive, decapitating geopolitical conflict in the Middle East paralyzed the logistical choke point of the Strait of Hormuz.
Yeah.
That paralysis caused a violent energy supply shock that paradoxically spiked the U.S. dollar in the short term, entirely because the U.S. is sitting safely behind its shale shield, while Europe and Asia scramble for expensive energy.
But dig under the surface data and we see this exact crisis has actively accelerated the dollar's long-term replacement.
Gold is breaking historical models because central banks are terrified of monetized U.S. debt. And the Global South has successfully launched the BRICS bridge to trade physical commodities without ever touching the American financial system.
The dollar is winning the violent sprint of early 2026, but the data strongly suggests it is structurally losing the marathon.
Which leaves us with a final paradigm-shifting reality to confront.
For decades, global markets and individual consumers have simply assumed the US dollar was the undeniable bedrock of reality, as reliable and ubiquitous as gravity. But if the dollar's current strength is actually just a temporary symptom of a legacy system in extreme terminal distress, what happens to the mechanics of your daily life when the rest of the world officially unplugs from the American financial matrix?
That's the terrifying part.
We've talked extensively about how central bank digital currencies facilitate global trade, but consider the domestic implication of that technology becoming the global standard. If the BRICS bridge model proves that all money can be a programmable smart contract on a state-run ledger, it fundamentally changes the nature of ownership.
It's programmable money.
Exactly. In a multipolar world running on programmable money, could your ability to buy imported groceries or afford heavily rationed gasoline be restricted with a single keystroke based on your nation's geopolitical footprint or your individual economic profile? The architecture for that level of control is already built.
It's not a matter of if the system changes anymore.
The only remaining question is, are you prepared to navigate a reality where the rules of money have been entirely rewritten?